Thank you very much for joining us for our first NASGP webinar of the year. I'm here with Tori Ferguson, who is a tax manager from Honey Barrett, which is a member
Hello.
of the Association of Independent Small Medical or Specialist Medical Accountants.
Yes.
We're going to be focusing on questions about GP tax returns today, and it'd be really nice to get started straight away. So I think we have would it be all right to start by introducing you, Tori, because some people might not know you?
Absolutely, yeah. So as you say, my name is Tori, tax advisor and head of the tax department for specialist medical accountant firm Honey Barrett. As you say, we're members of ASMA, Association of Independent Specialist Medical Accountants, which does not roll off the tongue, which is why we usually say ASMA. I'm on the ASMA Next Generation board. We're long-term supporters of NASGP, and I'm so pleased to have been invited to speak today. So thank you very, very much for having me again. I was just going to give a really brief overview of a tax return in general. Do you think that would be helpful to listeners? I know it'll sound so obvious when I say it, but sometimes you need to hear the obvious things. So if I give a really, really brief overview of what a tax return is and does, and then we open to the floor with questions, and possibly I've got a few questions that a lot of clients who come to us at this time of the year tend to ask us, so we can talk about those as well. So by way of an overview, the next deadline for filing a tax return is this coming 31st of January 2025. It's Friday this year. It's just over 3 weeks' time, so it's pretty close. And the tax return which is due by this date is for the 23 to 2024 year. And that, to be a little bit more specific, covers the fiscal year, which runs from the 6th of April 2023 to the 5th of April 2024. So it's any income which falls in that period that's rounded up by the tax return. Now that, in a sense, as an overview, the tax return is a form which, again, really obviously, reports all of your taxable income from all sources and all of your allowable expenses to HMRC for them to reconcile your overall tax position for a fiscal year, which means that absolutely all of your income, and I know I've said the word all several times there, but all of your income, unless it's specifically exempt, needs to be included on your tax return, even if you think HMRC already has the details. So that means if you're a GP locum or a GP partner who also has or had a PAYE salary job during the year, even though the payroll have reported your PAYE figures to HMRC, you still need to include that as well on your tax return, not just the locum work. If you have bank interest, which is below the allowable savings limit, you still need to put it on the tax return. Everything, unless it's specifically exempt, needs to go on. So there are a few examples of income which doesn't need to go on a tax return, doesn't need to be included. That might be bank interest received into an ISA account, for example, or dividends into an ISA. There are a few state benefits, such as maternity allowance or bereavement allowance, which don't need to go on. But generally speaking, if you've received income in a year, it needs to go on your tax return. So that's a really, really brief overview of what a tax return does, and basically reiterating that everything needs to go on it. So following that, what I might suggest is that we can either open to questions now, or I can give you an idea of some of the common things that people tend to ask us. What would you prefer?
Well, it would be great to go into the first question, if that's okay, and then
Of
it would be nice
course.
to hear what's really common from your clients.
Sure, absolutely. Please fire away.
Thanks. Oshuko, would you like to share a question with us?
Yes, please. Thank you so much. So the question I've got is I've got a private pension which was opened outside the financial year.
Yep.
I would like to make payments into the pension pot, but
Yep.
is it possible for me to still do that now, given that the pension was opened outside the financial year?
So you can absolutely make payments into the pension pot, but you can't claim them on the 23 to 24 tax return.
Okay.
So one of my questions that, one of the questions that people often ask is about claiming pension contributions. So we could go over that in a little bit more detail either now or after. Do you have a follow-up question, or was that the only one?
Yeah, that was the only one I wanted
Okay.
to clarify.
Let me talk to you then. So one of the things we really commonly get asked is how to claim pension contributions, and which boxes they go to on the tax return and how the tax relief works for them. So let me run through a few things with you, and if you still have questions, please feel free to ask after I finish talking. So pension relief, whether it is NHS pension contributions via locum A and B forms, whether it's private pension contributions, whatever it is, pension relief can only be claimed where the contributions have been paid in the relevant tax year. So on the 23 to 24 tax return, you can only claim for contributions which have been paid into that SIP or paid over to the PCSE, whichever one, between the 6th of April 2023 and the 5th of April 2024. So whilst you can still pay into your pension pot now, for example, the tax relief for those new contributions, additional contributions, would be given in the 24 to 25 tax year. So whatever tax year those contributions are paid in is the tax year in which you can make the claim for tax relief on your tax return. Now, the way that you make a claim for the tax relief is different. It depends how you're paying the contributions, what you're paying them into. So you need to be able to distinguish between private contributions and NHS if you are doing a combination of the two. Personal pension contributions are usually referred to as relief at source contributions, and they're contributions on which basic tax relief will have been claimed by your pension provider for you. So that's where you pay it into your SIP and the scheme sort of tops it up. The government top-up goes into the pension pot already for you. The wording on the tax return, when you're looking for the box to put it in, should reflect that phrase. So if you were to look at a PDF copy of your draft tax return, not the HTML version, the PDF one, the contributions would be referred to those on which basic tax relief is claimed by the pension provider, and they show on page TR4 of the tax return in box 1 or 1.1. And I know that's a lot of spiel and a lot of boxes and a lot of numbers, but there's a very big distinction between how the tax relief works and where the claim goes when you compare private pension contributions with NHS. Now, the private pension contributions, the one that say relief is claimed at source, they give you tax relief or additional tax relief by extending the amount that is taxed at 20% or 40%. So where you usually have an amount at which you pay basic rate tax 20%, it makes that amount larger. The NHS pension contributions are different. They are called a net pay arrangement. So the wording on the tax return or the tax return boxes refers to payments from employer scheme which are not deducted from your pay before tax. And in contrast, they're on page TR4 in box number 3. And these get deducted from your taxable locum profits before the rest of your tax is calculated. So if you put NHS pension contributions in the wrong box or SIP contributions in the wrong box equally, you get the wrong levels of tax relief. So it's important to get them in the right place, but especially in terms of timing, you can make contributions whenever you wish, but your tax relief is only claimed in the year in which you made the payments. So that's a very long answer to your question, but hopefully that's of help.
Yeah, that was helpful. Thank you so much.
You're very welcome. Right. Do we have any other questions anywhere?
Yeah, Tori, thank you for getting to that one so quickly, and I'm really
You're
glad,
welcome.
Shuko, we could help you with that. We've had somebody else join the call as well, but I think for now they probably don't have a question. Obviously, you
Sure.
can jump in at any point if you do have one. So I think there's some really interesting questions that you mentioned that you get quite commonly.
Yes.
The one that is sort of top of the list is about receiving income from overseas. Could you tell us a bit more about that?
Absolutely. So we have clients from all over the globe, as well as clients who, you know, did their training in the UK, decided to go to Australia is really popular at the moment. Everybody's going out to Australia, New Zealand, Canada. So perhaps they came from overseas to start with, or perhaps they did their training in the UK and they've taken sabbatical time and they've got assets in different places. Or they just had connections elsewhere. I myself am a US citizen and I have to do US tax returns as well. So it's a really common situation for a lot of people to have income in different parts of the world nowadays. And one of the things that we get in this scenario is people saying, well, I've received income from another country and that income has already been taxed in that other country. So, you know, it's already been taxed. Do I still need to put it on my UK tax return? And for the majority of people, the answer to that question is yes. The UK typically works by way of if you're a UK resident, then you are liable to UK tax on your worldwide income and capital gains. So if you're a UK resident, you're in the country, you're paying UK tax, it's on everything. There are some exceptions to that. So there are a couple of peculiarities for non-domiciled individuals who have only been in the UK for a certain length of time. If they don't bring their overseas income into the UK, although those rules are changing as of this April 2025, or otherwise overseas income which is exempt from UK taxation by virtue of a tax treaty between the UK and that other country. Although just because it's exempt doesn't mean you don't have to do a declaration and exemption or additional forms. So you don't, like 90% of the time, you should put it on the tax return, but there are cases where you don't. But I'm going to speak to the 90% of the time and the 90% of the people. So there are other circumstances as well where either you're coming to the UK partway through a year or you're leaving the UK partway through a year, where you don't necessarily include your overseas income. But again, you have to include the correct residence declarations and necessary paperwork to exempt or exclude the income in a way that HMRC accepts. So on the whole, even if you're a UK resident, unless some of these special situations apply to you, as I say, you're taxable on your worldwide income, so you include that overseas income on your UK tax return. But it doesn't necessarily mean that you get charged the full amount of tax for both countries in each country. So on the whole, there are provisions for double tax relief, or there are treaties between the UK and the other country so that the tax is limited to the highest amount payable. So if you paid more in the other country than you would do in the UK, you don't get charged more. Or if the UK would charge more than the other country, you pay a top up. So you sort of get a credit for what was paid in the other country so that you don't necessarily get taxed 2, 3, 4, 5 times, depending on where you're resident in the world. So even if there's no additional tax to pay on that income because of the treaties or because of a credit, ordinarily you'd need to acknowledge it somehow on the tax return. So yes, if you have overseas income, generally speaking, for most people, depending on special circumstances, you'd still need to include that on your UK tax return.
Well, it sounds like a lot of work, but at least we
It is.
we have an answer.
There's lots of forms to fill out usually.
Yeah. So we were going to focus on tax returns this month for obvious reasons, but we do have a question through about pensions, and
Sure.
it'd be really nice to tackle that if we've got time.
Yeah, of course.
So this one is from Ifeoluwa. She's asked, do you know when we need to pay into PCSE any contribution that we have to make on Form B for a tax year? Is that question clear?
I think it's sort of clear. So the timing of the pension contributions, is that in respect of what we discussed perhaps before you arrived in claiming the tax relief, or is that in terms of the normal pensioning limits? Perhaps if you could clarify that slightly, that would be really helpful.
Yeah.
Oh, thank you so much. I don't know what you had discussed before I came, but what I met you discussing was about the tax itself, which we should claim for that tax year when we are filing for that tax year. But my question is, because if like we do a locum and a practice pays a particular amount for a pension for us, we also need to add our portion and then pay that into PCSE. So, and I think there's also a deadline for that for a tax year. So I'm not sure how that works actually.
So for tax relief purposes, and I think this does touch on what we spoke about before you arrived, so let's reiterate that.
Sorry about that.
No, please don't worry. It's absolutely fine, because this is a really topical question and it's so helpful. So when you are looking at the tax year that we are talking about now, the filing deadline at the end of this month is for the tax year referred to as 2023 to 2024. That covers the year which starts on the 6th of April 2023 and runs to the 5th of April 2024. Why they picked that date, I will never know, but that's what it is. And the contributions that you are permitted to claim on your tax return as relief are any contributions which were paid during that same year span. So if you paid it over to PCSE, if you made your BACS transfer during the 6th of April 23 to the 5th of April 24, that's what you can claim for tax relief purposes on your tax return. In terms of where it's allocated to your pension record, usually if the payment in the session is clear that it's related to a specific pension input year, and the pension input year is a little bit different. It runs from the 1st of April to the following 31st of March. So for 23 to 24, that would be 1st of April 23 to the 31st of March 24. So where the locum work clearly relates to March 24, let's say, and the payment is made slightly after, but all of the locum A's say that that work was carried out up to 31st of March 24, and all of the locum B's corroborate that. Even if the payment is a little bit late, ordinarily, where the PCSE see those dates, they will allocate it to the pension record in the year to which it relates. So although the tax relief may be in the following year, the pension will pay for NHS pension purposes should be allocated to the 23 to 4 tax year. It can get confusing if you work a span of dates which go over, let's say, March 24 through to the end of April 24, and it's included as a date range that spans the 2 tax years. Sometimes PCSE will place that pensionable pay payment in your next record, in your 24 to 5 year. It depends how easily they can split the dates out. But if the payment is made slightly after and it's clear that the dates relate to the other year, they should put it in the correct one, if that's clear.
Okay, sorry, thank you very much. If I might give an example, for instance, if I did a locum job end of April, which is now 2024, 2025 tax year. So paying into PCSE, I don't know if there is any deadline or a time by which you have to pay for that
Yeah.
pension contribution. So that's my question.
Understood. 10 weeks from the end of the session date.
Okay. So if he exceeds that 10 weeks and the practice had signed a Form B that they were paying, so what happens to that contribution?
Oftentimes, occasionally, the PCSE will accept late contributions, and this is unofficial. I didn't say this out loud, but sometimes it's where it's all mixed into one locum B form and they can't easily take it out or distinguish it. Occasionally they will let it come through, or if there are mitigating circumstances, usually because of an illness on your part, let's say, they will let it come through. Otherwise, they may well reject that pension contribution because it's out of time, out of scope to be pensioned. In that case, you then go on to two different options. So option one, if that contribution has been rejected and it now sits in your bank account and in your pocket, you go back to the practice and you say, practice, you paid me late, naughty, but I was unable to pension this income. May I keep this as additional income for myself relating to my fee? And it may be that you have in your terms and conditions that if you're paid late, you reserve the right to retain the employer's contributions, for example. I don't know what's in your particular terms, but you go back to their practice and you say, may I keep this income or must I pay it back to you as I did not successfully pension? If you are permitted by the practice to retain that income, it becomes additional taxable income for you. Otherwise, if they say, no, you didn't pension it in time, yes, I know it's our fault, but you know, the terms of the agreement weren't met in terms of the pension contributions, then you must pay it back to them. So it's a conversation with the practice, or you need to make sure that your terms and conditions are very, very clear.
Okay, that's a lot I didn't understand. Okay, that's very helpful. Okay, so what I need to do then is to find out how I even pay it into PCSE, which is maybe they are not going to accept it anyway.
You can but try. You can ask them and see what happens. So there are two different methods. Are you using presumably the NASGP locum deck to generate the forms that they sign? So you have forms? Okay.
Yes.
So from there, you can use the PCSE Contact Us form to upload those forms. You can call the PCSE to obtain the NHS England bank details, and you would pay over that contribution using those bank details, using your reference to the PCSE with those forms. And that would usually mean that the payment has gone through successfully. Now, if you have, let's just say, let us presume that you had those contributions from April 24, you are now very, very, very far out of time. So the likelihood of acceptance is very low.
Okay.
And I would say realistically at this stage, you're probably having a conversation with the practice this far on to say, may I keep the contribution as extra income, or may I offer it back to you? But the process in general, I think, do you guys at NASGP, do you have any little webinars or anything about the submission to PCSE of the contributions?
Yeah, we've got an FAQ available. I'm not sure whether either of the GPs on this call have ever worked with our membership support team, but if you email info@nasgp.org.uk, they can supply you with the links that explain which routes you can take to get to PCSE and other kind of, you know, if you've got other kind of pension questions outside of this webinar, we can probably help with those too.
Okay, thank you.
No problem.
Okay, so and if they say refund it, how would I then? They will have to give me like a receipt to show I've refunded it. That will be an evidence, right, or something like that.
I think if you have an agreement from the practice manager, I mean, you can ask for a receipt by all means, but otherwise your bank statement will probably evidence the refund and an email confirmation. So it's, as long as it's clear on your bookkeeping for your accounts purposes, then the rest of the evidence will be there, but you could request a receipt.
Okay, thank you so much.
You're welcome.
Great. So we're still open to questions if you guys think of anything else. But Tori, when we emailed, you also mentioned that there was you often get asked about going just over thresholds, for example, the child benefit charge,
Yes.
personal allowance clawback, and the tax-free childcare threshold.
Yep.
Is that something you could give some advice on?
Absolutely. So a lot of, again, I'm talking from the perspective of a client who's coming to us at the end of January. And what they tend to do is they go, oh, you know, either I've almost finished my tax return, or I've given you everything for my tax return. And I've just realized that I'm just gone over the threshold for, let's say it's child benefit charge, or the 100k mark for personal allowance clawback, or the 100k mark again for tax-free childcare clawback. Is there anything that I can do to sneak back under that threshold in order to preserve my child benefit, my personal allowance, my tax-free childcare, etc.? And the answer is yes, but you need to act quite quickly. So I'll give you a little background, so to speak, and then we'll run through basically the one option that you have left to you in order to do something at the last minute about that threshold. So the first thing to check, which once again sounds very, very obvious when you say it out loud, but perhaps isn't as obvious when you're in the last minute throes of panic, going, oh my gosh, it's almost the deadline and I need to get this done, is to double check that you have included all of your allowable expenses, that you haven't forgotten any. So most of these calculations and threshold are based on a calculation called an adjusted net income. And that takes into account, it reduces your income by allowable expenses as a locum, by professional subscriptions, which are allowed against employment, for example. So if you're in a last minute panic and you're just, you know, grabbing at income and you've forgotten your use of home claim, or you forgot you purchased a laptop for work purposes, etc., etc., it's worth considering in the first instance, have you remembered all of your allowable expenses? Could that possibly bring your adjusted net income calculation down a bit? So that's point number one. Point number two is to consider things like the pension contributions which were paid within the tax year, both NHS pension contributions as a locum and the personal pension or SIP contributions paid otherwise, perhaps, and make sure that they have been included or correctly included on the tax return, because both of those things will reduce the calculation for adjusted net income as well. The other thing which reduces the calculation is gift-aided donations made to registered charities with the proper elections in place. So if you tend to go, oh, I really can't be bothered to add up that £5 a month subscription that I pay to Mind Health, you know, anything like that, any little subscriptions or any little payments to registered charities which you have gift aided, they are worth tallying up and they're worth adding on. So the starting point is to make sure that you have included what you've already paid properly, whether it's the allowable expenses, the pension contributions that you've made, or the gift-aided donations that you've made. Then the things that would typically reduce that threshold further in the calculation, as I say, are the pension contributions. So if you know what you're earning as you go along in a tax year, you can use pension contributions as long as you are comfortable with the annual allowance and not breaching that. You can use pension contributions to control those thresholds throughout the year as you go. But as we just discussed, if you don't pay it in the tax year itself, you can't backdate it. So it's a really great thing to do as you go. But after the tax year end has passed, it no longer becomes an option. So the only real option left as a retrospective adjustment is gift aid. And it can be really, really useful. So if you or your accountant says, okay, well, you're just over the threshold by this much, then you can look at how much money you would need to spend on a gift aided donation in order to bring yourself back below the threshold. And the beauty of that is that gift aid can be related back 1 year. Now I'm going to say this, it's very strict the way that it has to happen, but I'm going to say this really slowly, hopefully very clearly, so that you have a chance to take in the conditions and the rules. So if you can determine the amount that you need to bring your income down by, and you can determine that that's affordable for you to pay, then gift aid can be related back by a year, as long as that charity payment is made prior to the 31st of January. So for the 23-24 tax year, for which the tax return is due on the 31st of January 25, that gift aid payment that you want to relate back has to be made prior to the 31st of January 2025, condition 1. Condition 2, the proper gift aid declaration has to be completed and filled out, and it needs to be in your name. It doesn't work if it's in your partner or your spouse's name, even if it's from a joint account. It needs to be in your name and correctly completed. The donation has to be included as a payment in 24-25, which has been related back to 23-24, for example, on your original tax return submission for that year. So the first tax return that you send in for 23-24 needs to include that payment. You can't include it as a repaired tax return submission done after the 31st of January. And it has to be filed prior to the normal filing deadline, which in this case is the 31st of January 25. So if you do it super duper late, it's not going to help you. So those are the conditions that are needed to relate a gift aid payment back retrospectively to a prior tax year. And in that way, you can very legitimately reduce your income below the threshold and preserve those things such as child benefit, such as personal allowance, such as the tax-free childcare. Now, if you're around that 100k level and you think, oh gosh, but I've got to pay like maybe £1,000 worth of gift aid, if you think of what that saves you in terms of tax band adjustments, reclaiming your personal allowance clawback, and perhaps child benefit reclaim, particularly if you have more than one kid, that £1,000 gift aid, as an example, could be an awful lot cheaper than losing all of those other things. So you do also have to think of it in context and go, oh gosh, but I've got to find that. But you'd have to find a lot more tax and a lot more money to pay back otherwise. So there is a way to do it. It's not always affordable. Sometimes you've blown that limit by so much, you just have to accept it. But in cases where it's kind of borderline, there are ways that you could bring your income back down below that threshold for the purpose of adjusted net income and those calculations.
That's absolutely fascinating. Thank you. I think we've got one more from Ashiko, and
Sure.
maybe this might be our last one. Ashiko,
Absolutely.
are you okay to read it out for Tori?
Hello?
Hello.
Hi, I just wanted to ask, what's the maximum amount we can contribute into a private pension in the financial year?
That would seem like a really simple question to answer. And I'm going to give you lots of ifs and buts and maybes. So there are different I'm having thinking time here, so bear with me. I'm going to run through various things, and sometimes the best thing to do is to speak either to an accountant or an IFA for a final figure. But potentially there are different things that could apply. So the annual allowance is one thing to consider. The annual allowance is the amount of pension investment, pension growth that you can put into a scheme and get tax relief on in a tax year. So at the moment, for this current year onwards, for the foreseeable future, until the government change their minds again, the standard annual allowance is £60,000. And I say standard because if you are a high earning individual, and one of the thresholds that they consider as to whether or not you're high earning is whether your taxable income levels effectively breach the £200,000 mark. If your taxable earning levels breach that £200,000 mark, then that 60,000 could be reduced down as low as 10,000, or it can be all sorts of numbers in between. So if you are comfortably earning less than, a lot less than, whatever it is, £200,000 a year, then you will potentially have £60,000 that you could pay into a pension. Now, when we spoke a little bit earlier about relief at source pension contributions, the ones where the contribution claims back basic tax relief into your scheme, that £60,000 doesn't mean that you can pay £60,000 into there. It means that your payment plus the government's tax relief on top of it can amount to £60,000. So the amount that you personally could pay into there, which would equate to £60,000 once you have received the tax relief, is actually 48. Okay, so you pay 48,000, and then the government tops it up to 60. This is why pensions are such efficient investment vehicles for the future. So you could pay up to £48,000, but you can only pay in that much if something called your net relevant earnings is equivalent to that amount. So by the time you take your, say, employment earnings, locum earnings, and a few other things, if that is sufficient to support a similar level of contribution, that's fine. If not, the tax relief doesn't work out so well. Could it be a bit higher one year than the other? Well, if you've got more net relevant earnings and you've got unused annual allowance relief from prior years, then we start sort of going up and down. So there isn't a quick answer, because if I say, oh yeah, you could pay 60 grand in per year, it's slightly misleading and you may land yourself in trouble. So potentially into a SIP, for example, you could pay 48 grand on which you receive tax relief, which would mean that your whole pension increased by 60,000, but only if various different circumstances, various different criteria are met. So it's not a very clear answer, because unfortunately the legislation has been made quite complicated. But let's say you want to make a contribution of 20 grand, your earnings were well under 200,000, fine, should be absolutely fine. So long as you earn, I don't know, let's say, just got a calculator out, bear with me. At least 25. So let's say you earn less than 200, but at least 25,000 and you want to pay 20 in. Yep, okay. or thereabouts. But realistically, if you're talking about really, really, really large sums of money that you want to pay in, I would speak to somebody properly so that they can do the relevant calculations for you and you don't run into tax problems down the line.
All right. Thank you so much. That was very helpful.
You're welcome. Sorry, it's not clear.
It's great. It's great having the broad brushstrokes. Thank you. Okay, well we've had you for 3/4 of an hour, and I'm sure you're a little tired about talking about GP tax returns by now.
It's fine.
I'm sure I'm speaking on everyone's behalf when I say thank you very much for taking the time to go into the detail, and it's been really rich.
Yeah, thank you so much for having me. It's a pleasure.